This video is for regular during the period journal entries for a merchandiser, including journal entries for when you are the buyer and the seller. We're going to start with Blue Company is going to be the buyer. Journal entry number 1. Let's say Blue Company purchased 100 units at $50 each on credit. Because it's on credit, we're going to credit our accounts payable by $5,000. The debit account name for $5,000 is a new account name called Merchandise Inventory, and it's a new current asset for a merchandiser. Now, let's say in journal entry number 2 here that Blue Company, the buyer, returned 10 unwanted goods. We would, for this journal entry, debit the accounts payable to take down our accounts payable for $500 and again credit our merchandise inventory to take down our merchandise inventory by $500. That is again for the 10 units at $50 each that we had returned to the supplier or the seller because they were either unwanted or defective. Now, journal entry number 3, we're going to pay for the purchase within what is called the discount period. I wrote the discount period credit terms in green because it is the seller that gets to determine the discount terms or the credit terms. This seller offers 2/10 N/30 discount terms. A reminder, this means that the seller is offering a 2% discount if the buyer pays within 10 days of the invoice date. That is what the 2/10 refers to. Or if they don't pay within the 10 days, they get no discount and they must pay within 30 days of the invoice date. You must check your dates to see if you are within the discount period. So, if you noticed up above, we credited the accounts payable for $5,000 and then we debited the accounts payable for $500. So, the accounts payable account that we are paying off right now has a $4,500 credit balance and we're paying it off, so we would debit it for $4,500. But the credit to cash is not for $4,500 because we deserve the discount. So now we need to calculate the discount. This $90 is the calculation of the discount that I wrote up above. Right here we would show that we are paying for a $4,500 invoice and I'm timesing it by 0.02 because we get the 2% discount. So the credit to cash is for $4,500 minus the $90 discount, or a credit for $4,410. Now we have a journal entry that doesn't balance, so we need a $90 credit to balance the journal entry. What account name then is that credit for $90? It is merchandise inventory, and we are reducing the merchandise inventory not because of a physical return of goods like we did in journal entry number 2 above, but because the cost of the inventory did not cost us that $90. So again, the merchandise inventory current asset account, according to the cost principle, must be recorded at cost. Therefore, we would reduce the inventory account for the $90. The last item I wanted to discuss is what if the buyer had to pay for some sort of transportation or freight or shipping costs. So in this example, let's say that the freight cost an additional $20 and therefore we had to pay for it as the buyer, so I would credit cash for $20. Now I need a debit account name for the $20. And again, according to the cost principle, that $20 of freight in or transportation costs on the merchandise gets added to the merchandise inventory account, again according to the cost principle. So Looking at the 4 journal entries up above that we've done, there is a term called cost of goods purchased, which refers to the buyer and is adding up the amount that the goods cost the buyer. And the formula is as follows. It's also on another video to come. We are just tracking what is happening to the merchandise inventory. So the original purchase in journal entry number 1 added $5,000 to our merchandise inventory. But the $500 return in journal entry number 2 reduced it. The $90 discount from journal entry number 3 reduced the cost. However, if we have to pay for freight or transportation, we have to add that $20. That is how we arrived at $4,430 of cost of goods purchased. Now we're going to go over to the seller side. So we're going to come up here and we're going to say, okay, now let's, in this example, so that I can compare the two sides of this, let's turn around and pretend like, what would these journal entries have looked like if we were Green Company? Let's be the seller. So journal entry number 1. Green Company, the seller, sold 100 units at $50 each on credit. Let's start with that journal entry. I'm going to call it journal entry 1A. We would debit our accounts receivable account for $5,000 because we're waiting to receive $5,000 at this point in time from Blue Company. Now, in this case, we have a $5,000 credit account that is called sales revenue, instead of service revenue that we had been using previously in our service business. So this is the equivalent of doing a service on credit or on account. However, in this time we sold, which is what we do to be in business. This journal entry 1B here is highlighted because it's my most forgotten journal entry. Now we need to think that Green Company also has a merchandise inventory account. And if Green Company is selling the items for $50 each, I know that it didn't cost Green Company $50 to get those items. It cost them something less. So in this example, they just told us that the cost of those items is $40. So in this second journal entry, I call it journal entry 1B. It's the second journal entry required to be this on the seller date. We need to credit our merchandise inventory account to take down our merchandise inventory by the 100 units that we sold and by the $40 cost. Notice inventory is recorded at cost, so we would need to take down the inventory at the cost amount, not the selling price. So that's where we get this credit to merchandise inventory of $4,000. Now we need a debit account name for a debit of $4,000. And this is a new account that merchandisers have that is called cost of goods sold. The cost of goods sold account is an expense account, but it doesn't have the word expense on the end, so many students forget it. When we talk later about expenses, they forget cost of goods sold. So I'm going to write cost of goods sold expense there to help us remember. Okay, let's move on to transaction number 2. In this case, again, we are the seller and we are receiving the return, and for this first example, they're just going to be unwanted goods. When the seller receives a return of unwanted goods, they obviously need to reduce the accounts receivable that they're waiting to receive from Blue Company. So we would have to credit our accounts receivable. The accounts receivable is at the selling price. So we would need to credit the accounts receivable for the 10 returned units at the $50 selling price. We're also going to need a debit account name. The debit account name is not just to a sales account. It is to a new account called sales return/allowances, and it is a contra revenue account. So most merchandisers or sellers want to keep track of how much goods were returned to them. We do that through the use of a contra revenue account. Remember, all contra accounts still are linked up with their related account on the appropriate financial statement, in this case the income statement, which we will show in a later video. Now, in this example, when it was unwanted goods, or what I'm going to call good goods, we have to record a second journal entry. So I'm going to call this journal entry 2B. Went ahead and highlighted it in red here because it is one that you're going to have to think of. Am I going to need that journal entry or not? In this case, we received back 10 units, and they're good goods, so we're going to put them back on our shelves. They came out of our inventory at $40. They go back into our inventory at $40. We're not going to deal with any restocking fees here or anything. So we need to debit our merchandise inventory account for $400. And we will then credit our cost of goods sold expense account. So other than using the sales returns and allowances contra revenue account on the debit, if you look up here, journal entry 2A and 2B are just a flip-flop of journal entry 1A and 1B. Again, except for the use of the contra revenue sales returns and allowances in journal entry 2A. Now, if we received a return of defective goods that we are not going to try to sell at any price, we're going to say for this example they were just totally defective, it's not worth it to us to repair them, and we cannot sell them in their current state, we're going to throw them away. If we have defective goods that we just throw in the garbage, think about this journal entry where you're debiting merchandise inventory. If we threw those 10 cheapo somethings that were broken in the garbage, you would not be doing a journal entry to put them back on your shelves because we didn't put them back on our shelves. So basically there's just no journal entry 2B. Basically we've already taken them out of our inventory in journal entry 1A, and we leave it in as a cost of goods sold expense even though technically they weren't sold. All right, here we go. Let's receive the payment now within the discount period. Remember, the discount terms are our terms, and we created those to try to encourage the seller, or the buyer to pay soon. And this particular buyer is within the discount period. Let's start with the accounts receivable. Accounts receivable, which was debited for $5,000 in journal entry 1A, but credited for $500 in journal entry 2A, needs to be credited for $4,500. However, the debit to cash then is for the $4,500 minus the $90 discount that we had already recorded. And so the debit to cash is $4,410. Sorry, I said already recorded. I meant already calculated. And we once again have another journal entry out of balance, and we are debiting, in this case, a contra revenue account called sales discounts. And that's our new debit account name. All right. Only the buyer or the seller would pay for transportation. But if the seller would have paid, then how do they record that they paid the $20 of transportation? It is a shipping expense. Merchandise or some sort of a transportation expense or something, but it is an expense. Their cost of merchandise has already been established with any freight in they paid. We don't change that cost after it's been determined. Finally, we have a term called net sales. Net sales is the sales revenue from journal entry 1A minus any sales returns and allowances from 2A minus any sales discounts from 3. This formula will again be discussed on another slide. And that concludes the journal entries that can happen for regular during the period journal entries for merchant